47,000, Alicia, if nothing else, is representative of a resilient market.
Resilient market, resilient economy, despite all the fears and earnings that are being revised upwards, and the Fed is cutting into this. So we did have our vol scare. It took 3% off the top pretty quickly. And then ultimately what came through is that corporates are resilient, and whatever fears there were wasn't going to rebound further. In the end, the tariff conversation is quickly absorbed by markets to not be what's going to undo this.
What are you telling your clients?
Yeah, look, I mean, we're seeing the markets in a huge juggling act right now. I mean, they're trying to figure out the CPI numbers that are coming in that may or may not be true, that they're met with a lot of skepticism because of the government shutdown. You're seeing a lot of companies come in with strong earnings, and they become really resilient. Again, for our clients, we tell them, keep a balanced portfolio. Alternatives are very important. I think right now this continues to grow as we see the markets grow. And something that's really, I think people are talking about, but not enough, is this whole AI thing. I mean, this could be...
Not enough? People aren't talking about it enough?
This could be the global...
Where are you hanging out?
This could be the global revolution of anything like infrastructure, like railroads. I think this is the next step of technology that is just in the first or second inning.
Well, people do talk about that, and they say earnings and the economy, as you said, and rate cuts, and you put all of those things on the list, and it's kind of hard to bet against all that, even if you have some concerns around the edges.
So it's good there are concerns on the edges, because you don't want a straight rocket ship up. You want a conversation. You want a two-way conversation in the market. We had that 10 days ago. But ultimately, if earnings come in better than expected, and if the tech stocks really pull out, the AI trade is intact, you have your next leg higher from here. I agree with Mike. You really have to get through that 6,800 level on the S&P to really be convinced that there's another leg here. That's on the technical side, but on the fundamental side, I think we get there.
How do you feel about the bar for tech earnings this season?
I think it's relatively high because you didn't get the usual downgrades of expectations through the quarter. The margin of beat is almost definitely going to be lower within big tech than it has been. And I think, to me, it's much more about how the stocks have set up. I like that there's been dispersion within the Mag 7. You got 3 stocks that are more or less flattish year to date. Amazon, Apple, Tesla, and then you got 4 that are up 30+%. And the market keeps kind of shuffling around. You've had Amazon down, Apple up all week. So I think that's all healthy. But I do think the flip side is a resilient market that all we got was a 3% pullback when you had these kind of dual challenges to the bull case means we didn't really get any kind of a reset lower and some kind of a flush. So maybe it's just got to happen sector by sector, and you see some of the speculative stuff move today on the downside.
Well, because maybe we jumped to conclusions a little bit on some of the credit-related and loan issues that were out there, and we assumed that there aren't just a few cockroaches, as Jamie Dimon said, that there must be more, and maybe we'll still hear about more. But it doesn't rise to the level of great concern that it's going to upset the story.
Right, and you have such strong earnings coming in so far, and the CapEx spending that's going on right now, there's so much money on the sidelines. A lot of these technology companies we're talking about, and AI companies are talking about, they don't want to be left behind. They need to stay ahead of the game, and the CapEx that they're putting in to the spending for the growth may affect earnings a little bit, but at this point, when you have such strong earnings and decent economic numbers, you might see a pullback, but I just see, 6 to 12 months, there's a lot of positives in the markets.
Is that your favorite part of the market, the mega caps? You just urge people to stay there?
Look, I think
in size?
We have a total, allocation package, but as far as the equity place,
what does that look like?
It looks like about 40 to 45% equities, 30 to 40% fixed income, and 25 to 35% alternative investments. Because at the end of the day, alternative investments are what protect you in a down market. And at some point it's going to come. When it comes, obviously none of us know, but it's, and people that are looking for safe interest, low volatility, absolute returns, that's a key component to it.
Well, people are questioning whether part of that is safe, in quotes.
Yeah.
Are you?
I'm not. No.
You don't have any issue, any concerns around credit?
Credit, people are talking about a lot. I feel like
that's part of alternatives.
I feel like it's the market neutrals, the uncorrelated asset classes. I feel like a lot of the low volatility, 4 to 6% vol, looking for a 5 to 7% coupon. That's where we're really focused on. You might see credit spreads, but that's going to affect the whole market if there's a lot of credit concerns that can.